Good morning or afternoon, everyone, and welcome to the Benefits of Sell-Side Quality of Earnings Analysis and Reporting webinar presented by Hein Associates. I'm Shannon Reddy, your moderator and webinar organizer today. Before we start, let's take a moment to cover a few housekeeping items. All audio lines are muted. Please use our chat feature to ask questions. We will save time at the end for Q&A. This webinar is being recorded. A copy of the webinar presentation and its recording will be sent out to all registrants later today. Your active participation is important throughout the session. In order to receive CPE credit for this session, you will need to be connected for a minimum of 50 minutes and must answer 75% of the polling questions included throughout the presentation. Immediately following the webinar, you will be directed to the survey page where you can leave comments. Please check your inbox later today for a follow-up email that contains an evaluation form that must be submitted in order to receive your CPE certificate for the course. Our presenter today is Guy Knuff, partner in our Orange County office. Guy joined Hein Associates in 2016 as a partner. He is responsible for the Transaction Advisory Service Department in Southern California. He has over 25 years of experience advising entrepreneurs, private equity and strategic investors, lenders, and other capital providers on merger and acquisition, divestiture, and ESOP transactions ranging from $10 million to $1 billion in enterprise value. His clients have included both high-tech and entrepreneurial companies within the manufacturing, distribution, retail, service, contractor, and real estate industries. The agenda for today's meeting is to, 1, briefly go over the buy-side due diligence, an explanation of the sell-side due diligence, an exploration of the advantages of benefits of preparing a sell-side quality of earnings report, or Q of E. Before we begin, we'd like to start with our first polling question to understand our attendees. Please answer the following questions with the options below. My career/professional years of experience: 1 to 3 years, 3 to 5 years, 6 to 10 years, 11 to 20 years, 20 plus years. Please make your selection now. Thank you for your answers. I will now turn it over to Guy Knuff.
Well, thank you, Shannon. I would like to start the presentation by jumping into what our learning objectives are. They follow our agenda, but I would like any presentation, to go over those first. The first learning objective is to understand what a quality of earnings report is. And believe it or not, that's a question that I receive all the time. What is a Q of E and what is a quality of earnings report? So today I'd like to really have you leave this presentation with a clear understanding of not just what due diligence is, but what is a quality of earnings report. Secondly, to set a basis for what sell-side due diligence is, we really need to understand what is buy-side due diligence and the related procedures. So we're going to do a survey, explore some buy-side due diligence, just really to lay a foundation for the next learning objective, which is to understand what is the purpose of sell-side due diligence in the related procedures. Also, another very important concept and a frequently asked questions and kind of a misunderstood area in due diligence is knowing the difference between audit procedures and due diligence procedures. I frequently get a question as, well, when we have an audit, do we really need a quality of earnings report? Or vice versa. We're doing a Q of E. I don't think we really need an audit. And we'd like to really clarify the understanding of what is the difference between audit and due diligence procedures. And lastly, let's explore the advantages and benefits of conducting a sales side due diligence engagement. So if we can walk away with that today, I think you'll be able to go forward with a good understanding. So let's jump into our next. Let's start with quality of earnings, and it's really, anybody these days can Google quality of earnings and be directed to a definition, and a definition is always a good place to start. If you Googled quality of earnings, you're going to be directed to Divestopedia, and they have a definition that I think is pretty good. It starts as follows: the primary objective of a quality of earnings report is to assess the sustainability and the accuracy of historical earnings, as well as the achievability of future projections. So there's a lot in those 3 lines. There's a lot packed in there. So let's pull it apart and really look at the 3 main considerations that we just discussed in a definition. So first, accuracy of historical earnings. How do we assess that? Well, frequently when we get a new client and we ask for a set of financial statements, those financial statements, are they audited, are they reviewed, or are they compiled by a reputable CPA firm? Or, consequently, are we provided with a set of financial statements that are internally prepared, maybe on an annual basis? The management of the company gives those financials to their tax CPA. They formulate a few adjustments and prepare a tax return. So there's a big difference in the accuracy that you perceive in historical financial statements when you know, as a due diligence person, that I'm looking at audited financial statements versus statements that are prepared by management. Secondly, quality of earnings. Well, what's that mean? Well, think about a company that has consistent revenue growth, is producing positive cash flow from a diversified product line within an expanding client base in multiple industries, both domestic and internationally, versus a company that has concentrated cash flow from 1 or 2 very large customers in a narrowly defined industry. Think of the assessment, your quality assessment of the earnings. And last, sustainability of future earnings. In this area, we look at management systems, accounting systems, operational systems, the management team. Do we have a management team that's had a company like this and grown it and sold it 2 or 3 times? Or is it somebody's first rodeo? Capital expenditures, deferred maintenance. And we look at all these factors in total to really look at what are the quality of earnings. So it's obvious the accuracy of historical earnings, but we need to look deeper than that. And this is really the definition of quality of earnings. So let's jump into buy-side due diligence. Now, I actually love this picture. When you look at this picture, it's a nice break to jump in. It kind of looks to me like somebody sitting there with 4 hands. It's actually 2 people sitting there side by side. But when I look at it, it kind of reminds me of what it's like to be somebody that goes on and does due diligence. You kind of feel like at times you have to have 3 or 4 hands. There's so much to do. And in buy-side due diligence, typically a deal starts with a letter of intent. So 2 parties are negotiating a deal, and they come up and say, you know what, let's enter a letter of intent. And they agree to a period of exclusivity. Let's just say, for example, it's 120 days. They come up with a potential price that they agree on, and they agree to conduct due diligence during this exclusive period. Well, typically, in the letter of intent, there is a window for due diligence, and that's usually somewhere around 30 to 45 days. So the minute somebody calls me up and says, hey, we just signed a letter of intent, we'd love to engage your firm, we sit down and we put an engagement letter together, we define the scope, and based on looking at the financial statements information, we present a request list of the items that we will need. So we have 30 to 45 days to get done our due diligence. And typically, the first thing that happens is we send over our request list, and clients will say, hey, wait a minute, it's going to take us 2 to 3 weeks to prepare that. Well, when you got a 30 to 45 day window, frequently that's delay number one. And so it's kind of foreshadowing what we're going to talk about on the sell side, but let's get into buy side due diligence. So what we have here are some sample due diligence procedures. But before we jump into those, what I'd like to do is, at this point, discuss the difference between audit procedures and due diligence procedures. Now remember, if you're familiar with audited financial statements, the purpose of those are somewhat different than that of due diligence. And I said earlier, one of our objectives was to point out specifically what is the difference between audit procedures and due diligence procedures. Well, in an audit, you have a CPA that's making an assertion on the financial statements taken as a whole. And this kind of goes to the accuracy of those financial statements we talked in the very beginning, and to the credibility. The auditor needs to make an opinion, right? And in that opinion, they're going to state, and I'm paraphrasing, that the financial statements are presented fairly in all material respects, but they're going to say that the financial statements are presented in accordance with general accepted accounting principles as a whole. In due diligence, we don't always have a materiality, and we're looking at very specific items that are of concern. So I'm going to give you just a brief example. Let's talk about concentrations, right? Let's say a company has 3 customers that make up 45% of the revenue of the company. In an audit, that's going to be disclosed. There's going to be footnotes that are going to tell you exactly that. Well, if I'm making a buy decision on the company, that gives me a good feeling that the financials have been audited, and in accordance with U.S. GAAP, this disclosure is required. But I want to know specifically, who are those 3 customers? What are their collection policies? What's the relationship with those customers? Is it growing? Is it going to continue? So due diligence procedures is that information that you as a buyer want to accumulate to make a buy decision. And financial statements are prescribed as an assertion on the financials taken as a whole. So hopefully that may clear it up a little bit, that they are not the same, and sometimes some of the procedures that we're going to go through are going to look like audit procedures, but their purpose, their intended purpose, is different. The other thing that I want to point out is that in a buy decision, the sufficiency of the procedures that are conducted under due diligence are really determined by the client. Are you the company that's buying another company? Do you have enough information to make that decision? And so anyways, let's jump into a few sample due diligence procedures to kind of set the stage. The first one we have listed here is revenue and gross profit margin. Now, we're going to want, under due diligence, look at that. We're going to bifurcate it or split it up many different ways. We want to look at due diligence. We want to look at gross profit margins and revenue by month, by region, by plant, by product, by machine, and salesperson. And once we have that information and we look at the charts and graphs, many trends will pop up, and we're going to look for explanations as to why certain things happen. Customer analysis. We briefly discussed, we want to understand the relationships, the health of that client, the industry. There's all kinds of information that we want to understand in a customer analysis. Vendor analysis. We want to understand the ability of our current vendors to deliver. What's our capacity, and what's our risk? How many vendors do we have? Seasonality, the ups and downs of the revenue in the business. Is there any exposure to the holidays? Is 45% of our revenues accumulated during the holiday season, and the rest is spread out evenly. Concentrations, we briefly just discussed that. Concentrations of what? Well, concentrations of customers, vendors, the industry, geography, and we'll run all kinds of trends and ratios in kind of the same format as the revenue. We'll look at things by month and really try to get a complete 360 picture of this company. To the right here, we presented a little example of a proof of revenue. Basically what this is kind of an analysis that goes through looking at the cash flow that we receive, the deposits in the bank statements. We make a few adjustments for receivables and other items, but does the cash flow of the company that's being received match the revenue? So it's called a proof of revenue. Just a little example here of a due diligence procedure. We also look at working capital, which is current assets on the balance sheet minus current liabilities. And it's a very important concept, and we'll dive deeper into working capital. And also cash flow, which is frequently used term, EBITDA, which is earnings before interest, taxes, depreciation, and amortization. Let's explore a few more sample due diligence. And I want to dive a little deeper into the EBITDA and the working capital. And the reason why EBITDA is important, we have an analysis on the right side, a little chart here. It's very easy to take a set of financial statements and say, okay, what is your net income? What is your interest, your taxes, depreciation, and amortization? And come up with what your EBITDA is reported. So if you're looking at that little chart, you can see 2014, 15, and 16, and we just have a sample here of EBITDA, and that's as reported. So that's coming straight off the financial statements. EBITDA is important because it represents the cash flow of the company, and it's a valuation consideration. It's frequently used. The EBITDA in industry multiple is multiplied times that EBITDA to come up with an enterprise value of the company. And so if there's adjustments to that cash flow, both positively and negatively, it impacts the valuation of the company. So let's look at some samples of types of things that we look at in diligence. On that same chart, management typically goes through and says, you know, we have a bunch of add backs to our EBITDA that we think if we sell our company, maybe there's certain management fees that the company won't experience if it's sold. Obviously, any deal expenses that are incurred are add backs, and our CEO salary and expenses, CEO bonuses and other incentives. Yes, we may have to hire somebody to continue to run the company, but you know what? As an entrepreneur, I paid myself a very high salary, and here's really an add back to the company. And so management will come up with their adjustments to say, okay, here's what the EBITDA of the company is after management adjustments. And so that's all considered. But what a diligence expert does is come out and say, okay, let's look at some of the other areas, and basically they're looking for deductions. And they're looking for areas to say, you know what, you haven't considered this fact or another fact, and based on those deductions, it would reduce the cash flow or EBITDA of the company, times that multiple, potentially reduce the purchase price. So let's look at a couple examples. Improper accrual accounting. Maybe we didn't accrue for vacation. It's very common. There's certain current versus long-term classifications, or improper add-backs. In this case, we show some obsolete or excess inventory that should be removed. There may be some warranty claims or some deferred maintenance that needs to occur, all to be considered. One thing I did want to point out on here is that on buy-side due diligence, frequently there's other expenses that as a diligence person we go out and we find There may be certain lifestyle expenses that won't be repeated if the company is purchased, or other items. And under buy side, the company that will frequently say, hey, we found these deductions, but infrequently will they ever share with you opportunities to improve the purchase price. So wanted to point that out as well. Okay. So a couple other, we're pretty close to the end of buy-side due diligence, but a couple other assertions that I wanted to point out were, areas that we dive deeper than a traditional, if you have a set of audited financial statements. You have a backlog, and in your financials it may say, we have a backlog of X millions of dollars. Well, under due diligence, we want to look at that backlog, and we have an example to the right of all the customers and the potential backlog that exists. And we're going to dive into that and really understand probabilities and the type of customers and the type of contracts, et cetera, that are there. Projections. We want to understand and analyze those. Retention rates of employees. We have a little chart down below. We'll look at retention rates of employees and proper GAAP accounting. Another set of potential due diligence procedures. Okay, so let's kind of talk in summary buy-side due diligence and then get into the sell side. Wanted to clarify audit versus due diligence procedures and the purposes. The purpose of buy-side due diligence is to identify internal control weaknesses in the systems, personnel, assess the earnings and cash flow, analyze the quality of the assets and liabilities, and evaluate the quality of the working capital, recent trends, again, the valuation concept, EBITDA and working capital adjustments, and identify issues that are unknown to the buyer. We're going in trying to find additional information so that a buyer can make an informed decision as to whether to buy the company. And the last thing I want to point out, we're not really going to dive into this, but the deal structure, the complication of the deal structure, will determine the depth of the procedures. If there's multiple plants, multiple geographic locations, if it's an asset sale versus a stock sale, all those issues will define how in-depth the due diligence procedures are.
We have our next polling question. The primary objective of a buy-side due diligence is the following. 1, assess the accuracy of the historical financial statements. 2, understand the sustainability of the future revenue projections and earnings. 3, analyze the quality of earnings and assets. Or 4, all of the above. Please make your selection now.
Hey, look at that. Well, I must be doing a good job. Actually, I know the question was a softball. But the reality is we want you to understand, and it was important to understand the purpose. So let's dive into sell-side due diligence. And what I have here is an explanation. Actually, we have our next
polling question. Do you want to kind of go over the sell-side due diligence first, Guy?
Oh, yeah. Okay. It looks like we have a polling question. Let's go back to our polling question real quick, right here. Okay. Basically, this question was to just understand from the audience if you expect to be involved in a sale within what time frame. So it looks like about half our audience really it doesn't have an expectation to be involved in a transaction, but obviously this is educational for you. You may be a professional or your company may be involved in one. Additional information for you. And it looks like the other half in the next 2 to 3 years potentially could be involved in a transaction. So let's talk about sales side and what it is. Okay. Sell-side due diligence, what is it? This actually is a definition from a potential client of mine, and I wanted to throw this up here to show you and explain it. I had a client that I started discussing sales-side due diligence with them, and they said, okay, my understanding of sales-side due diligence is that my company sponsors internal due diligence on our company in which a sell-side Q&A report is prepared by an independent third party. This information is then shared with prospective buyers and paid by the seller. And I had to say, true. Yes, you do conduct internal due diligence on yourself. You're going to share this information, and yes, we're going to ask you for payment. And the first response that I got was, well, doesn't the buyer have a CPA, and don't they do due diligence, and don't they ask me for information? So shouldn't I just give them what they ask for and nothing more? And don't they have to pay for it? So why should I be paying for this? And many times this is why sales side due diligence, boom, stops right there, and we don't go on because from that perspective, it's kind of like, well, why do I need to do this? Well, there's many great benefits, and I want to talk about those first. So let's talk about sell-side due diligence and why do it. Well, most importantly, the first item is that you desire a transaction that's the right transaction. If you're going to sell your company, you want an efficient and effective transaction. And many deals, we could bring in many investment bankers, and they can tell you all their stories of where two companies are on the altar. They're ready to exchange vows, ready to exchange rings, and then something pops up and they find out, and it changes everything. And there's additional negotiations, and they may never get back on the altar again. So this has been driven in part, sales side, by giving yourself a better chance to complete a good transaction. Do transactions get done without sell-side due diligence? They do. Is it more likely that a transaction will be more efficient, more effective? I believe that it is, and I think if you talk to investment bankers, they're going to tell you the same thing. You're trying to maximize your value, you're trying to limit your risk, and you're trying to close a deal on time. And by doing sales-side due diligence, and we'll get into the specific procedures, but the biggest benefit, the number one benefit, is you want to get a deal done. You want the right deal done for you. And for most entrepreneurs, this is they built a company, their life, and this is cashing in. And so not being prepared for buy-side due diligence, for me, seems a little foolish, but the benefit of that is to have a more efficient and effective transaction. Secondly, proactive versus reactive. When you're selling your company, would you rather be on your toes or on your heels? And when you conduct a due diligence sell side, you're going to uncover additional knowledge. It's going to allow you to anticipate questions from the buy side. We did a little sample, just a sample of what you're going to be under siege when you're selling your company. Wouldn't you like to have or prepare those answers, knowledgeable, well-educated, professional, credible responses to the questions that you're going to receive? It allows you to control the process, which is very important in selling your company. It allows you to tell your story in your words. One of the examples I like to give is when I'm on the buy side, I call it the third question. I'll give you an example. I come in and I meet an owner of a company, and I ask him, among many questions, I'll ask him or her, what's your gross profit margin? And the owner will very proudly tell me, my gross profit margin is 50%. And that's great, and you applaud them for it. And then you ask them, how many products does your company have? And they tell you, we've got I think about 200 products. And then you ask the second question of, well, what's the gross profit margin by product? And very frequently, you hear the lights buzz. There's no response to that question. Think about if you asked that second question and somebody said to you, instead of not knowing, well, the gross profit margins for those 200 products is somewhere between 5% and 80%. And obviously that would spawn the next question of, well, why do you have a product that's a 5% gross profit margin? And then they proceed to tell you, to your third question, well, we found strategically that all our competitors have product A, which is a 5% gross profit margin. However, we bundle our product with the 80% and 90% gross profit margin products. And in bundling, we achieve a 50% gross profit margin. You can see the credibility, the understanding. You know that owner understands their business. They understand their numbers. They understand their marketing, and they have a strategic position. When you conduct sales side, it allows you to prepare, because you can be coached to say, hey, you're going to get this question. You need to be able to understand it, and it helps the owner understanding their own business as well. So credibility is a big, and credibility and trust, telling your own story. Next item we have is opportunity to create awareness and set the right tone. Well, create awareness basically means let's not leave any money on the table. When we were talking about EBITDA earlier, when we go through on a sales side due diligence, we're looking for opportunities to add value to your company. Can you imagine if you left an item that could be $100,000, $200,000, $300,000 add back that was unlocated, and you have a multiple, industry multiple of 5, that could be $1 million to $1.5 million of valuation that was not uncovered when you're going through the buy process, and a buyer isn't going to tell you that. So anyways, it gives you the opportunity to create awareness, to set the right tone, and be prepared. I personally, it's the old Boy Scout motto of being prepared when you go into a transaction. And there's many benefits from that. And let's talk about the last few we have listed here. More work up front. Look, I'm the same person. I switch my hat. Somebody hires me to come in and do buy-side due diligence, or they hire me to do sales-side due diligence. Well, gosh, when I'm on the buy side, I know the questions I'm going to be asking. So when I turn around and I'm on the sell side, I know how to prepare for those same questions. And the items that I'm going to request are going to be the same items. The work will need to get done. If you do it on the sales side, it's just going to allow you to do it under your timetable and prepare for the buyer. But whether the work will need to get done. So the point is, you might do more up front. It may be a cost, but you're going to be better prepared. Reduce overall due diligence and other costs. Well, other costs are really legal fees. The longer a transaction goes, the more costs that are going to be incurred, more time, and less likely that the deal will ever go through. And lastly, this is, I would say, the second most important item, and it may be the number one. Number one is really a more efficient and effective transaction, but right behind that is allow the management team to focus on running the business. And you need to finish strong. Frequently I coach clients. I say, you have to almost be a schizophrenic, because you're going to undergo all this due diligence, and you're going to go through a ton of emotion of selling your company, and frequently your employees, they have no idea that this is happening, and yet at the same time you need to run your business the same as you always have. And I don't know how many times that you're going through a transaction and the numbers start to slip. So you go through and you're doing all your due diligence, the legal work, everything that's happening, all the meetings, and the numbers start to slip. If you're prepared for your due diligence and take a very proactive approach, that's going to give you a better chance to finish strong and focus on running your business. And I have to say, owners frequently underestimate the amount of time that it takes due diligence. And I have an example this last year that I was on the buy side of a engagement. It was going very well. We finished our Q of E report. Everybody was talking to the lenders to get the transaction done, and Q1 numbers came out and they significantly dropped. And basically it was the owner and management took their eye off the ball and the deal got shelved. And believe it or not, the numbers picked back up in the next 6 months. We got a call, asked to refresh or roll forward our Q of E, and the deal did end up closing. So it's a clear example of giving yourself the ability to finish strong. So let's just kind of talk about the sell side process. Typically, just like buy side, it's going to start with an engagement letter. Somebody, and we're often frequently referred in by an investment banker these days because many investment bankers have had many busted deals and they've invested a lot of time and money, that a lot of investment bankers are requiring sales side Q of E reports. So we get referred in by an investment banker. We provide an engagement letter and go through, and we define our scope. We define the procedures that we're going to do to help you. And you have, as the seller, you have a lot of input into these different areas. Most engagements take 30 to 60 days. If we uncover something, hey, you may decide not to go forward with your transaction. It may be that significant. But did you want to go to market not being ready? And an investment banker may say, you know what, let's get this fixed and let's go back to market in a year and have a successful transaction. What do? Well, we request a lot of raw financial data from you, and we'll place it in a model. And that model will kick out trends and charts, and we're going to analyze the various same questions that if we had our buy side hat on, what would we be asking? And we're trying to take that proactive approach and analyze and get responses, predetermined responses, and provide a potential buyer with all that information up front. We're going to try to get an understanding of your accounting policies and procedures and disclose those as well. And certain procedures are applied to verify certain accuracy. We're not going to do an audit, but there's certain procedures where we need to verify certain things, and we'll conduct those as well. In the same fashion, continuing on, we're going to look at things like customers and concentrations. We're going to conduct a site visit. We'll come out to your facility and we'll observe operations. We'll interview personnel. And this can all be done. One of the biggest worries that owners of companies have is that it's going to get out that they're selling their company. And a lot of really well-run companies have consultants helping them with many of their processes and procedures, and we would be acting as if we're going through those same processes. And so a lot of times the fear that I'm selling my company and it may get out, that can be mitigated as well. Then after we conduct all our procedures, we're going to prepare a draft report and provide that to management. And you as management have an opportunity to provide us comments and suggestions, and we incorporate or change our report. A lot of times, we come out and we listen and we hear, but we may not get it right. And there may be certain nuances or industry complications that we need to clarify. So you're going to have input and say, and this information will be given to potential acquirers, but again, you're telling your story. You're giving them the information they're going to ask for. So that's kind of an overview of the process. We have some more in-depth, if we got a little time to go in, some of the more detailed procedures that we would go through in our analysis. We talked about looking at audited financial statements reviewed or compiled. A lot of times the optimal sales side engagement will include audited financial statements, a sales side Q of E, and a confidential information memorandum by an investment banker. Usually those 3 documents can provide sufficient detailed information for a potential buyer going through the letter of intent process. We're also going to analyze your revenue and margins. We've kind of discussed that. What else? We're going to try to identify one-time expenses, again, focusing on EBITDA, one-time expenses versus recurring expenses. And it's very critical point to go through in that regard, because one-time expenses may include things that how they're analyzed. One may say they are a one-time expense, and others may say they're not. For example, recruiting expenses, legal expenses. If you have a lawsuit that's a one-time event, or are you in an industry where frequently you have lawsuits that are ongoing? Well, that's kind of a recurring business, expensive business versus a one-time expense. You have a state audit from some business that you did in the state of Louisiana. Well, that's a one-time event. If you're audited every year in the state, there's a certain way that you do business that ends up causing you to be audited. Well, it's a recurring expense. Things like inventory certifications, like ISO, the initial expense that you spend to get that certification, versus ongoing monthly, a reduction in force. There may be severance payments, inventory write-downs. So you can see there's all kinds of one-time expenses that can be added back to increase the value of your company. Understand and analyze the assumptions related to the projections and the impact of the management team on revenues and expenses. Again, after a transaction, what's going to happen? Is management going to stay with the company, or are they going to be leaving? Frequently, there may be 3 owners, and one owner says, you know what, I'd like to stay with the company. I'm young, I'm early in my career, I'd like to stay. You may have 2 older owners that say, you know what, it's time for me to cash out and move on. And what's the impact of that on the company as well? Here's the whole list. I won't go through this in complete detail, but we look at the business environment. You know, the history of the business, competitive, regulatory environment, areas where the buyer can maximize value. We look at operations, products, accounting, the quality of the management team, the cash conversion time, capital expenditures, the historical financial results. We talked about quality of earnings, etc., taxes, employee benefit plans, all detailed items that we go through. So. And again, we're going to talk about EBITDA. I beat this up pretty good, but the add-backs, deductions, the financial due diligence, and in a sales side, we have this example on the right, which is really what happens in a buy side. In a sales side, you're going to present your EBITDA as reported from your financials. If you have audited financials, it's easy to gather that data, and we'll present management's adjustments. And we end there. That's it. The diligence adjustments occur on the buy side. We're going to present to those that are coming in on the buy side, here's our EBITDA number. And again, there's a few more common adjustments. I think we covered most of these. Let's talk about a few additional roles where your due diligence team can help you in the engagement. Analyzing bids and offers. No 2 LOIs are the same. Frequently, the terms, the dollars can be measured, but frequently the terms in the LOI may need a CPA. Tax strategies and after-tax proceeds. Very critical. If you're selling your company, you want to be planning your wealth management. You want to understand, hey, I sell my company for $20 million. How much am I going to put in my pocket? It may not be part of the sales side due diligence, but it's something that you should know going into a transaction. Financial modeling. We're going to help you make sure that they're realistic, and we can help you in that area. You're going to have an investment banker that's going to set up a data room. We can help with some of the analysis in that regard as well. And lastly, we can assist management on the with buy-side diligence questions. If you do a sales side due diligence and there's a bunch of questions, your team that helped you on the sales side, they're educated now, so we can help you with the process. Okay, a couple concepts that I want to cover real briefly. Working capital. I briefly covered that. It's an important concept because if you look at your financial statements, your balance sheet, and you take your current assets minus your current liabilities, that's your working capital. In a transaction, you agree as the seller to deliver a certain amount of working capital, and that's worked out in a definitive agreement. And typically there's a target number, and obviously the buyer wants that working capital target number to be as high as possible, and as a seller you want it to be as low as possible. And there's a lot of things that impact it, seasonality, growth, financial statement adjustments like warranties, accounts receivable reserves, different company policies and industry practices. But a key point is, if there's excess working capital, typically the seller is allowed to keep that. And so it's an agreed upon target, and that's part of on the sales side due diligence. Proactively, you can come up with an analysis of what that number is rather than having to defend a much higher number. You can come in with your lower number to start. Okay, let's go through, kind of review real quickly the sales side due diligence and the advantages and benefits. In 2015 and 16, it was estimated that nearly 40% of the deals went 15 plus weeks and beyond the letter of intent date. And many issues were found, and it could be mitigated with sell side quality of earnings. And every day post an LOI is another day that something could happen to kill a deal. So as we discussed, doing a sales side QOV allows management to focus on daily operations while the diligence team focuses on fielding questions from buyers. Very important. Augmenting your internal management resources with experienced resources so you can complete the transaction. Sell side, again, it forces the seller to accumulate financial and operational information that answers buyers' questions ahead of time. Again, it gives you that opportunity. Improves the accuracy of historical and projected financial information. Yes, you may have audited financial statements, but when the second and third questions are asked, you have the sufficient information to have credible, trusted responses. Minimizes surprises. Bankers, investment bankers, lenders, nobody really likes surprises, and to add transaction value by adding credibility and objectivity is critical. It also, sales side mitigates the negative deal outcomes by addressing issues early in the process. And, we talked about EBITDA, potential opportunities to come up with positive adjustments to increase your valuation, and again pointing out that potential acquirers will only inform you about negative adjustments, not positive. Collaboration with the investment bankers to address risks early. Again, speed to close. Provides buyers with a transparent, objective, and credible view of the business. And provides one consistent set of analysis to distribute to potential buyers. When you go through to sell your company, you may have 50 companies that are interested, and that may get boiled down to 7 companies that you bring in to do a presentation. This gives you the advantage of giving them information. You tell your story on one platform. Rather than having to answer something 7 different times, 7 different ways, you can provide the information and hopefully reduce the amount of inquiries. Increases competition between the potential buyers, minimizes negotiations after the letter of intent is signed, increases the quality of bids and maximizes the sale price. Again, we throw in there offsets the cost of due diligence. I think it offsets the cost of many other costs. And maximizes the after-tax proceeds by addressing risks and optimizing deal structure. Okay, so I wanted to come up with, one final conclusion, and a sales side quality of earnings report provides greater transparency and credibility while allowing the seller to maintain more control over the sale process, thus reducing disruptions to daily operations. As a result, this allows the seller to focus on completing the right deal. And I run into this every day. I just had one last week where somebody is not prepared for a transaction, and it's very difficult. You're on your heels, it's very chaotic, and the owners are saying, look, I need to continue to run my business, and had they had the ability to be prepared, I think that the result will probably occur, but it would be a more smooth and maybe a better deal. So anyways, that's the conclusion. I'd like to, at this time, I think we've got one more polling question, I think. Is that correct, Shannon?
Yes, we do. So
Okay.
This question is, what are the benefits of sales side quality of earnings reporting? 1, opportunity to be proactive rather than reactive. 2, a more efficient transaction. 3, allowing the seller to control the due diligence process. Or 4, all of the above. Please make your selection now. And also, given that earlier we kind of went quickly over the third polling question, we're going to be asking that again to give everyone an opportunity. So you'll see this next polling question appear on your screen. The question is, expect to be involved in the sale of a company within the following time frame: 1 year, 2 to 3 years, 3 to 5 years, or no expectation. We would now like to have a Q&A quick session with the few minutes we have left. To ask a question, please submit a question via the chat box located in the lower left-hand corner of your screen. If we don't get to your question during the webinar, our presenter will follow up with you via email.
Okay, very good. Looks like our first question. Are sell-side QVs better suited for small companies or big companies? Oh, great question. Well, actually, they're suited for both. You're going to have somebody that will be hired on the buy side, and that's the point. If you have a company that has as little revenue, and I don't mean little, but if you have revenue that is over $500,000 or $1 million, and somebody's going to buy your company, frequently a buy-side due diligence person is going to enter the picture and go through the process that we discussed early on. So being prepared as a small company is just as important as a large. And what can happen when you work with like ourselves, we would customize the approach. Obviously, if you're working with a company that's a $100 million company that's very complicated versus a company that's $1 million, we may be able to do a summary report or a report that may not be as sufficient in detail, but is affordable for your level. So it's important to be prepared for a sale, whether you're a small company or a large company. See if we've got any other questions. Okay. Second question. is there a standard form for QOB? Another great question. I've been frequently asked that, and the response is no. There really isn't a standard form. Most companies are different, and they require sitting down and understanding the scope for that specific company, for that industry, and what's important to understand from a buyer's perspective, what's important to make that buy decision, and as a seller, providing that information so that you have a good outcome. So there is no standard form. Let's see, we've got another question here. Approximately how often do you see a seller engage in a sales side quality of earnings process? Great question. I have to say there are certain investment bankers now that because they've had many busted deals and have invested millions of dollars with bad outcomes, that they are mandating it. That if you go to them, they're going to say, look, we're mandating a sales side QOB. And that's starting to pick up speed. I would have to say a few years ago, it would maybe be 20%, 30% doing sales side. And now I'd have to say that that's probably 40, maybe pushing closer to 50%. Okay, we've got another question here. What are the range of costs for buy side, and does the size and amount of earnings affect that cost? Yes, it does. The range of costs on a buy side, again, it depends on the complication of the transaction, and how what are the critical points. If it's a small transaction, as we described, a company that's got $1 million or $2 million in revenue, there may be, you know what, I'm doing an asset purchase and I'm buying receivables, I'm buying inventory, and that's what I'm concerned with as the acquirer. I'd like you to just customize your procedures to that area. Or it could be very complicated, and there's all kinds of analysis, and we do sort of a wall-to-wall approach. So it really varies. I can't throw out dollar amounts, but it really does vary, and it's really the complication. Okay, let's see. I've got it's great bunch of questions here. And again, if I don't answer them, if we go over time, Shannon, just stop me. Let's see.
I think this will be our last question.
Okay, last question. It was mentioned that an engagement can take 30 to 60 days. What impacts the range if a seller, or the range on that? So, okay, yeah, typically on the sales side, it does take about 30 to 60 days. But again, we usually do this in unison with an investment banker who's working with the company to prepare a confidential information memorandum. And if we hit an area where we're not prepared, where we need to go back and do additional analysis, you have the option. You haven't gone to market yet, so you have the time to do whatever you need to do to get prepared. So usually it's 30 to 60 days, but yes, it's taken longer. And in fact, there's been times where we've hit an issue where we've had to put it on the shelf, and then something had to be fixed by the company, and we come back to it maybe 3 months later, and we have to update all the work. But typically it's a 30 to 60-day engagement. And I see I've got several other questions here. So my email address is listed, and feel free to email me any other questions that you have. It has been great, and I appreciate the opportunity to present. Hopefully you've been able to walk away with a better understanding of quality of earnings and the learning objectives that we outlined in the beginning.
Great. Thank you, guys. Thank you, everyone, for attending. Please check your inbox for a follow-up email with an evaluation that must be submitted in order to receive your CPE certificate for the course. We appreciate you attending today and have a great day.